Hi, I'm Matt McAleer, Director of Equity Strategies at Cumberland Advisors. It is April 29th, just after the close. I'm with the Moose, John Mousseau, CEO and President, runs our fixed income trading department. This week was another ugly equity week.
And a month you're glad to say goodbye to, whether it's bonds or stocks.
Well, you look through the first 4 months of the year, and it's the worst 4 months, worst start to the year through April in something like 50 years. So we'll see where we go from there. What have we noticed this week? Listen, if you're looking straight at indices and markets, fairly ugly. Previous areas of demand didn't hold up. Right. So that's a warning right away. Because listen, you can take 10, 11% drawdowns in the S&P and respond and rally from them. And I often say the key is staying in the game.
Right.
And to stay in the game, there are times you have to play defense. We've done, and we're always our biggest critics, and we dissect what we've done. Normally that 20% cash level will get you through most rough patches.
Right.
This year it hasn't been enough cash. What we've noticed this week were some extremes that have started to show up. I know in the press you often read about sentiment indicators and how an extreme in negative sentiment can correlate to a bottom or a reason to rally.
Right.
While I think sentiment's interesting, I prefer to actually look at the trading, right? And a couple of things have shown up. We've got 10-week numbers down to an area that have produced rallies in the past. We've gotten 10-week momentum numbers to areas that have produced rallies. More importantly, last Friday we did see the equity-only put-call ratio. Now, folks, you haven't heard me have to talk about the put-call ratio since March of 20 in the midst of COVID, when it spiked through 1 4 times. Between the, let's call it the 10th of March and the 25th of March. When the put-call ratio, equity only, spikes through 1 or gets close to 1, you're getting some extremes in negative action in the market, actual bets being made. We did see it last Friday get close to 0.9.
Right.
That's not through 1, like I like to see. I'll be very interested today to see where that got to. That used to be, from a trading standpoint, John, if you were short the market,
right,
or you had a negative position on in the market, and the put-call ratio got through 1, without any questions asked, you just covered your short.
Because that was the crescendo.
You had gotten to the point where now you were taking too much risk to stay short. So I'll be interested to see, I'll look tonight over the weekend to see where that got today. I mentioned some of the extremes we've seen and where we might want to be a buyer. I'm going to put up a chart right now on a ETF we nibbled on. We have some history here. I've been talking about it for a little while. XME is a metals ETF that we own in Tactical Trend. And if you recall, John, it had a heck of a run from about $42, $43 at the beginning of the year up through, hit 65, 66. We had sold half our position at 59. It ran up to 60, 65, and I wanted to wait till it pulled back to reload that position. That's what we've seen. So that's telling me we've even seen pressure on the good names, right? The metals got thumped. When I look at this chart, why do we add to this position on Wednesday? Well, you see the yellow circle. That is a upturn in the 10-week for the metals non-ferrous, which equates basically with XME. What this is saying to me is it got down to where only 8% of the metal stocks were trading above their 10-week moving average.
Wow.
And then it turned up on Wednesday. Now, I don't care what the sector of security is, I'm going to buy that.
Right.
Why? Because just like bond trading, all we're trying to do is put the odds slightly in our favor. And having used this kind of material from Dorsey Wright for almost 30 years now. I know when you get to single digits in momentum, in positive momentum, and you get a turn up, it has paid to play it. Does that mean this trade will work? We don't know. All we've tried to do is put the odds in our favor a little bit.
Right.
So that was a trade we did this week. Moose, how about in bonds? I've gone long enough.
Bonds, quiet week. We could use it. Treasuries, actually down in yield a little bit. So a couple of basis points. The 10 years at a 290, the 30 years at a 295. The 5 years around a 290, and the 2 years around a 270. What does that tell you? Yes, you have a fairly flat yield curve, but then if you look down a little more, the 3-month T-bill is around 85 basis points. So it's still almost 200 basis points between 3 months and basically going out to 10 years. So there is room for the Fed certainly to hike rates. On the other hand, you look at the kind of damage that happened in the stock market this week, and you start to look at some other economic numbers, and listen, there's a lot of cross currents, right? You saw things like durable goods up. You saw house prices, up a lot, 1.5% for the month, 20% year over year. On the other hand, you've had 3 months of declining new home sales.
Right.
You saw negative GDP for the first quarter over last quarter. So they're starting to see signs that the work-at-home economy is gone. Normalcy is back. We've seen that in some of the tech stocks. On the bond side, what did we see on munis? We saw muni bond fund flows still be negative, but less negative. And that 4% yield that you hear me talk about in a world where a long treasury is at 3 basically, and you're buying something that's well over 135% of a treasury, and it's tax-free and it's high grade. We're still continuing to push that trade through with the idea that ratio comes down to 100, so it means that a long muni bond at 4 can survive a grudgingly higher rate of a treasury yield moving up and probably stay stable or maybe even go down a little bit. And what will help that? It's those bond fund flows which are becoming less negative, and as yields go higher, eventually the tide turns and they become positive. So a little better week for bonds.
Good. And John, you mentioned cross currents, right? And there are so many cross currents that we often remind each other and in our meetings that you can always find something that supports your view.
Right.
And that's dangerous, right? So we try to find often some things that fly in the face of what our leaning is. But in terms of what we're looking at from the equity market, and I'm circling back around to the Fed, who have been fairly aggressive in talk about what they're going to do, whether it's 50 basis points 4 times in a row, and you've heard certain governors even talking about 75 basis points. Often the markets will start to cap inflation before the Fed can.
Absolutely.
And we've seen that multiple times over the last few decades, where that kind of pressure in an equity market slows down the consumer, higher rates slow down the house buyer, and markets start doing the work of the Fed.
Right. And there's no question that you look at bond yields, and we said this before, if you look at the structure of yields and where they are, and look at a 10-year, call it a 290, hit 3% last week, takes you back to where you were kind of in the middle of 2018. In other words, kind of like a year before things all went to heck because of COVID and stuff. And what is it that has scared the bond market and clearly has scared the stock market is not the level of rates, but how fast you got there from the low in rates, last year. And, that's what spooked things. But the more you kind of hang around here, the better things should be to move forward.
Okay. Thank you, Moose.
Thank you, Matt.
Everybody enjoy the weekend. Don't forget to like, comment, subscribe. If you have a question, reach out. We'll try to address that. Been a tough start to the year. Keep grinding. Keep your confidence level. And I mention that specifically because that's a very important part to an investor or trader's makeup. And if you need to raise some cash to what I like to call the sleeping level, don't be afraid to do it. Okay? Don't get into a scenario where you have to be right on the market and prove you're right on the market. If you need to raise some cash, the market will trade next week. It'll trade the week after. It'll trade next month. You'll have that ability to get into some reasonable names at discounted rates. So enjoy the weekend. We'll see you next week.